Very good morning. Very good morning, friends. So, we are resuming our learning for today, and our agenda is going to be, as discussed, we will be first doing accounting standards, the balance portion, and then we will be covering yet again certain topics which are more scoring from your exam perspective, which is redemption of debentures and redemption of preference shares. Right? So, with no further delay, let's directly get started into accounting standards. So we learned 4 standards in the previous session. So we're going to start with the next standard, accounting standard 12. AS 12, accounting for government grants. And this is again a standard which is holistic in coverage. So basically it is going to cover what is a grant, measurement of a grant, how a grant has to be presented and disclosed in the financial statements. Right? So now first let us understand what is a government grant. A grant is something that is given as an assistance or as a support to boost your business or to ensure that you are more motivated to the business, etc. So government grants are assistance by government in cash or kind to an enterprise for past or future compliance with certain conditions. They exclude those form of government grants or government assistance which cannot have a value placed upon them and transactions which cannot be distinguished from normal trading transactions. So here I am splitting it into 2 parts. First, government grants, they are assistance given by the government, be it state government or central government or any form of government. And it is given either in cash or in the form of assets or any other kind, okay, for past or future compliance. A grant is not generally given simply by the government. So it is given with a purpose. So what is the purpose? It could be to motivate that particular industry or upbringing of a backward area, something like that. Now when there is a purpose, what happens? The government has to ensure that the purpose is achieved. So it will always attach conditions with the grant. Like for 3 years, you should do minimum operations, something like that. Or you should have completed this much turnover, or you should have this much turnover. So something like that. They do have some conditions that are attached. So it can either be past conditions which have to be fulfilled before obtaining the grant, or conditions which you are sure that you will fulfill after obtaining the grant. So this is how a government grant is given. Now what is not a government grant? Those forms of assistance given by the government which cannot have a value reasonably placed upon. So what does that indicate? If suppose, friends, we all know that income tax is giving us various forms of benefits. Okay, now income tax, in that, suppose you have a benefit saying you can claim additional depreciation if you are a manufacturing entity. That is also a government support only. Okay, but can you ascertain the exact amount of support that you are going to get benefited from it? No. In one time, we cannot ascertain. Every time we purchase a machinery, maybe that benefit is passed on, but at the time of that support being given by the government, we cannot ascertain how much benefit the entity or the enterprise is going to receive. So they do not form part of government grants. So basically, any deductions or any tax exemptions, tax holidays given by the government are not forming part of government grants. This is part number 1. Part number 2. If you are a person who is dealing with the government in your ordinary course of business, if your entire business is dealing with the government, you do contracts for the government like laying roads or infrastructure contracts or some technology related contracts. If in your regular course of business, if the government is one of your clients or customers, then they will still be paying you money in the form of a customer, in the capacity of a customer, and hence they will not qualify for a grant. In other words, the amount received from government in the capacity as a customer will not be treated as a grant. Okay, so what is the in simple meaning? Grant is a separate amount that is received or receivable in cash or in kind for certain conditions placed by the government towards the enterprise, right? So this is about what is a grant, so measurement. Next point, how a grant has to be recognized in the books. Two conditions. First, where there is reasonable assurance that the enterprise will comply with the conditions attached. Suppose the government says that yes, I am willing to give you a grant, okay, but provided you have to show an employment of so many number of people for 3 years. Minimum you should have 10,000 employees in your organization from this particular area for 3 years. If you are reasonably sure that you can achieve that particular number, then we can go ahead and recognize the grant. However, if we are not sure, when we will not be sure, for example, if we may have practical challenges in achieving that condition, it can be very difficult condition for us to achieve. So suppose if they are saying I need to employ so many persons, minimum of so many persons in this within this tenure, whereas there are some laws in that local area whereby I'm not able to fetch as many employees as I could be possible, or maybe I need some category of skilled workers which is difficult for me to fetch from that area. Practically, political challenges or geographical challenges, right? So if you are having a certainty that you can achieve these conditions, then grant can be recognized. And second, most importantly, the benefits have to be earned by the enterprise and there should be a reasonable certainty of collection. So basically, it is not just enough that you apply for the grant. How a grant process happens, you apply, government takes the process and then it has to grant or it has to approve. Until the approval comes, there is no reasonable certainty. Just because you have applied does not mean you can recognize the grant in the books. Application can happen in, I could have applied even in 2016 or 17. But if the application is processed in 2021, I can recognize the grant only in the year of 2021 when the grant accrues to the enterprise. So two conditions. One, there should be a reasonable certainty of fulfilling the conditions which are attached with the grant. Second, the benefits should have accrued or been earned by the enterprise. Right? So that is why, because it is basic prudence principle. Anticipate gains only when they are accrued and not when they are yet to be accrued. Right? So this is about measurement. Now let us understand how we are going to record these grants in the books. So we have seen when we have to record, which is the point at which we need to record. Now let us see how the entry has to be passed or how the recording has to be made. Friends, grants, we are going to classify it into three types. So what are the three types or broad classification? Grants received in cash or cash equivalents. Second, grant received in kind. So what is kind? Instead of government giving you cash or cash equivalent, it is giving you a property directly. It is giving you probably a land space saying use this. Third is a middle way. Government says you buy the property or you buy the asset, I will reimburse you later. That is what is called as grants for specified assets. Okay. The purpose of each grant will differ and accordingly the type of grant will also differ. Now let's first take cash grant. Grants which is given in cash. Now if I take a cash grant, friends, if you understand why a grant is given, it can be given either for two purposes. One, either you want to build your infrastructure or you want to build your business, start and develop your business. Or two, it can be in the form of subsidies. What is subsidies? Basically, they are motivations. Motivation for doing a better business or for improving a better business or for doing a business in an area which the government wants us to do. Like for example, if you are you are going to set up a particular business or let us say a cafeteria. Yes, ma'am? Yeah. Not necessarily Section 8 alone, any other entities also. For example, if you are going to set up a cafeteria or set up an IT cafe or something like that, government wants to boost this kind of segment in let us say cantonment areas, or in let us say special economic zones or industrial areas where there is a central government ownership or state government ownership. So what they may do, because it is remote, probably the owner or the proprietor may not be interested. So what they will do, they will say, boss, if you are you can sell it to the to that particular region at so and so rupees, I will compensate you for the whatever is the remaining loss, or I will bear the expenses for you on your behalf. Please set up the business, do your operations, I will bear the rent on your behalf, or I will bear the additional expenses on your behalf. This is possible. So there are two types. Either they can motivate to do your business, improve your business, or they can motivate for doing your infrastructure. When it is infrastructure, or when it is related to capital investments, in simple words, it is more like a capital contribution. So that grant received or the money received becomes capital in nature. And that is what we call as capital approach recognition or capital grants. Okay. So what will be the journal entry if it is a capital grant? Very simple. Bank account debit or grant receivable account debit when the grant is going to be received. Grant receivable account debit to capital reserve. To capital reserve. Why? Because it is in the nature of promoter's contribution or the owner's contribution. It is partaking the character of shareholders' funds or owners' funds. So, because I cannot show it under capital, I show it under a separate reserve, which is capital reserve. Second type, if the grant is given for your business motivation or business encouragement, then in that case, what happens? That type of grant partakes the character of income. Partakes the character of income or revenue nature. So basically, if it is revenue in nature, it has to affect your profit and loss account. Simple rules. Anything which is revenue in nature goes and hits your profit and loss account. So in that case, that is what is revenue approach of recognition or revenue grants, where the amount of grant which is received is taken to the period of to the profit and loss account in the period in which the grant is receivable. Suppose if they are saying, I am going to bear the rent for every month, then for the 12 months, recognize the grant. Next 12 months, recognize it in the next period. So accordingly, you will defer your recognition based on the amount to be recognized in P&L each year. So based on the amount that has to be recognized in your profit and loss account, the amount of grant will be taken to P&L account either in one shot or as a deferred revenue. So what will be the journal entry in that case? Grant receivable account debit to profit and loss account, because it is taken as an income or proportionate income. Okay. So if you see the journal entries, it is grant receivable account debit to either capital reserve if it is capital or profit and loss account if it is revenue in nature. And then comes the receipt entry, which is cash or bank account debit when you actually receive the money, to government grant receivable. So the first one is the accrual entry and the second one is the receipt entry. So this is about cash grants. Clear with this so far? Next, what we go is towards grant in kind. So what is grant in kind? When the government decides that it is going to give you a property or an asset directly for usage. So which means when it is giving an asset, naturally an asset is a capital nature transaction. So it is going to be recorded under capital reserve. Very simple. Okay, if it is a capital nature transaction, assets are all capital nature transactions only. So it is going to go to capital reserve. Now the challenge with this is, what is the value? Cash grant means I will know the amount. But if it is kind, what will be the value? The standard says, if it is received at any consideration, say if the government asks you to pay even 10 rupees, that 10 rupees becomes the value of the grant. Whatever consideration has been paid to the government for acquiring that asset, even if it is 10 rupee, 15 rupee, 1 lakh, 2 lakhs, whatever is the value, that becomes the value of the grant. What if it is given free of cost? If I have to still record that asset, so what I will do? I will record that asset at a nominal value. Nominal value can be like a very small amount. Okay, in some places even 100, 200, just because they have to record. Like that they will take it into consideration. So grant in kind, if any consideration is paid, then the amount of consideration shall be recorded as the value of the asset. Whereas if the asset is given free of cost, then the same will be recorded at nominal value. Journal entry, asset account debit to capital reserve. Because why this is capital reserve? Because an asset is generally capital in nature. Now comes the third, which is in between both. Grant received for specified assets. What is specified assets? Where the government says, I will give you grant provided you are going to buy this particular asset only. In other words, the government directs you to buy that particular asset and then it will reimburse or directly pay to the buyer or to the seller, whatever is the agreement. So you have to actually, in specified assets, how it will happen is you will actually submit the invoices to the government saying that, boss, I have placed my order. And then government will process your grant. That is how it happens. So the asset is already identified, right? Now here, since the asset is already identified, we are going to record the grant along with the asset only. There are two methods for recognition of this. What is the first one? Where in the cost of the asset, the grant value is reduced. So if I have to give the journal entry, what will be the journal entry? It will be grant receivable account debit to asset account. So the value of the asset or the cost of the asset is reduced. And then this is the accrual entry. Coming to the payment entry or receipt entry, we will have cash or bank account debit to grant receivable. Okay. So here what happens? I have reduced the cost of the asset. If I had purchased the asset for 10 lakhs and the government grant was received for 2 lakhs, now my recognition is only going to be for 10 minus 2, 8 lakhs. Now in this case, the book value, in the books, the cost of the asset reduces. So depreciation will be provided on the reduced value of the asset, which is reduced book value of the asset. So you will not charge depreciation on 10 lakhs, you will only charge depreciation on 8 lakhs. This is method 1. Now in this, one of the most important points to note. Suppose I had purchased the asset in the year 2017. In the year 2021, the grant was provided. Okay. Now, 4 years depreciation is already charged. At that time, I was not sure whether it will come or not. So, I have charged depreciation on the original cost. Now, grant is provided. Can I subtract the grant as it is and then record and then go ahead and provide for the remaining depreciation? No. I have to assume as if the grant was received earlier. Suppose on the day 1 itself, if grant was received, then what would have been my depreciation. So I have to revise the depreciation backwards. So please note, if the grant is received subsequent to the purchase of the asset, then the depreciation and book value of the asset is recalculated with retrospective effect. That is, as if the grant was received on the date of capitalization. Okay? So we need to give backward effect or retrospective effect. Is method 1 clear? For depreciation, the journal entry is normal depreciation entry, depreciation to asset account or depreciation to provision for depreciation, whichever method you are following. So depreciation entry will not change. The amount calculation will change if at all the grant is received later.
For the past years, ma'am?
Okay, for the past years. So your question is, what will happen to the difference in depreciation because of the grant? It will be adjusted accordingly in your reserves. The excess amount or the deficit amount, generally it will be excess amount, excess depreciation, that will be adjusted in your general reserve. Okay, it will get adjusted in your general reserve. So I can also give that journal entry for your reference purposes. The excess amount of depreciation is adjusted in general reserve. So the entry will be now here what happens? The depreciation reduces. So the reserve balance, if the depreciation reduces, the reserve balance will increase. So asset account debit or provision for depreciation, if at all we are following accumulated depreciation method. Okay, accumulated depreciation account debit to general reserve. Is that clear? Now, method 2. In this method, this is a more preferred method in certain cases because here I am not adjusting the grant value with the value of the asset. What I am going to do is, I am going to retain the asset at its original cost directly and take the grant to a deferred income or deferred grant account. So I am going to create a separate account where this grant will sit and this grant amount will keep getting amortized over the period. So method 2, the amount of grant is taken to deferred grant account and asset is retained at historical cost. So here, what will be the journal entry? It will be grant receivable account debit to deferred grant account. And of course, the receipt entry, bank account debit to grant receivable. And the next entry is what is going to be more important, where the grant amount which is standing in deferred grant will proportionately be charged to income or be taken to income in proportion to your depreciation. In proportion to the value of depreciation or in proportion to the depreciation of the assets. So for example, if the asset that you are taking is having a useful life of 10 years, the grant will also be deferred over a period of 10 years. Okay. So depending on what proportion of depreciation you charge, the grant will also be deferred over that period. Right? Here it is the period which is relevant, not the method of depreciation which is relevant. The depreciation can be SLM, WTV, whatever it is. But useful life of the asset is what is going to be relevant. Okay, so what will be the entry here? The entry for every year for taking the amount to P&L account will be deferred grant account debit to profit and loss account. Deferred grant account debit to profit and loss account. So here the point to note is depreciation is going to be on historical cost. Depreciation will not be on the reduced value because you are not reducing the value of the asset here. Okay. Which method to choose? The enterprise has the option. Whichever method it is choosing, it has to disclose it in the financial statements. The enterprise or the entity has the option to select, and whichever method they do, whether it is method 1 or 2, it is going to result in the same impact in the P&L account or same impact in the books. Right? So this is about recognition of grant. So there are three types: cash grant, grant in kind, and grant for specified assets. Clear so far? Now comes the last part of the grants segment, which is when a grant is refunded. So when will a grant be refunded? A grant is refunded when you are not fulfilling the conditions, or after fulfilling the conditions you have gone away or deviated from your conditions. So basically, if you are not fulfilling the requirements of the government or the conditions imposed, then the grant becomes refundable. It can be a partial refund or a full refund. When it is refunded, the entry will be reversed. So if it is, if originally you have recorded it as grant receivable to capital reserve, now it will be capital receivable to grant payable, capital reserve to grant payable, or capital reserve to cash and bank. If it is P&L, grant receivable to P&L, reverse. P&L to grant payable or grant refundable. Okay, so the entry or the journal entry is going to be reversed in the books. Now here, if it is cash or kind grant, we don't have a problem because we don't have the issue of depreciation coming into picture. But when it is going to be specified assets, generally when the grant is given for depreciable assets, okay, plant and machinery, etc., the depreciation also needs to change accordingly, because now your asset value is changing because of this grant, refund of the grant. So in case of grant for specified assets, when the cost is adjusted, which is method 1, if you are following method 1, originally you had reduced the asset from the grant from the cost. Now we are going to reverse it. The grant refunded will be increased to the cost of the asset. The grant will be increased. So what will be the entry? Asset account debit to grant refundable. Asset account debit to grant refundable. So let's write that entry for reference. Asset account debit to grant refundable. And then when the grant is paid, grant refundable account debit to cash or bank. This is when the grant is refunded. Now, the second part of the story, what happens to depreciation? Here, the depreciation will be changed prospectively, which means book value as on date. add the amount of grant refunded. Whatever is the revised book value divided by the remaining useful life. So there is no backward impact. If you are in the 5th year out of say 8 years, 5th year, whatever is the book value, say let us say the reduced book value is 3 lakhs after 5 years depreciation. Now I am refunding a grant amounting to 5 lakhs. So 3 plus 5 book value becomes 8 lakhs. 8 lakhs divided by remaining useful life of 3 years close. I am not going to go to the whatever happened in the past. I am only going to take from the date of change. Right? So this is like AS10. What we saw in AS10, prospective effect or prospective change. Whereas when it is taken to deferred grant, which is method 2, the amount remaining in the deferred grant account will be cancelled first because there will be some amount of unamortized grant. So the entry is going to be deferred grant account debit. Two, grant refundable. Here the asset account will not be touched at all because here I am not using the asset account for recognizing the grant. I am only using deferred grant account. So asset account will never be touched. Asset is already at historical cost. Keep it as it is. Deferred grant account debit to grant refundable. Suppose deferred grant has 3 lakhs balance. I am refunding a grant worth 5 lakhs. How it will happen? Probably you have taken a grant for an asset which has a useful life of 10 years. After 7 years, some condition was not fulfilled, so you have to refund the grant. Now what happens? Asset deferred grant has only 3 lakhs balance. I am refunding 5 lakhs. So 3 lakhs I can knock it off with deferred grant. The balance 2 lakhs is a loss. And we all know whenever we are going to speak of a loss, who will come into picture? Profit and loss comes into picture. So profit and loss account debit. For the excess amount. Excess refund. So deferred grant account debit to the extent it is available. Profit and loss account for any excess. And the difference will be adjusted accordingly. Now here, no change in depreciation, no change in the cost of the asset because we have not touched the depreciation and cost of the asset. So no change in depreciation. No change in depreciation. So what are the points that we will remember from AS12? First, what is grant? When a grant can be recognized in the books. So what are the two conditions for recognizing the grant? How a grant has to be recorded? Cash method or cash approach? Sorry, cash grant, kind grant, specified assets. What are the journal entries for recognizing the grant? What will happen to depreciation when the asset is recognized in the books? And the last part is what happens when a grant is refunded. Right? So this summarizes AS12. Take 2 minutes and run through. And then we will start with practical questions. I hope the AS is as such clear. So let's start with practical questions. Question 1. A fixed asset is purchased for 30 lakhs. Government grant received towards it 12 lakhs. Residual value is 6 lakhs and useful life is 4 years. Company charges depreciation on straight line method. Asset is shown in the balance sheet net of grant. So this statement indicates it is which method? Method 1, where the asset cost is adjusted. After 1 year, the grant becomes refundable to the extent of 7.5 lakhs due to non-compliance with certain conditions. you are required to give the journal entries for the second year, which means they are not asking you the journal entries for grant received. They are only asking you the journal entries at the time of grant refunded. So we are only going to focus on refund related journal entries. Before we go into refund related entries, let us calculate the book value as on the date of refund, and let us see what other impacts of depreciation, etc. Let's go ahead and do the calculation. Okay. So year 1, what is the amount of asset purchased? 30 lakhs. Okay, I'm writing it in lakhs. Now, the residual value will be 6 lakhs. Okay, so residual value is 6 lakhs. So therefore, the value that we are going to depreciate will be for 24, and depreciation for year 1 will be, the useful life is 4 years. So 24 divided by 4, 6 lakhs per annum. 6 lakhs per annum. Now, when we are going to speak about calculation of the book value, so we have cost 30 lakhs minus depreciation for year 1, 6 lakhs, which gives you 24 lakhs as the book value for year 2. 24 lakhs as the book value for year 2. Now let us see what happens. The grant received is 12 lakhs. Have we accounted for this grant while calculating depreciation? No. Which means your depreciation that you calculated for year 1 itself is wrong. So remember, whenever you are going to see the question which is net of grant, calculate the depreciation only after adjusting the grant value. So please make a note of it. Okay, common mistake. What we will do is, we will by default we will calculate depreciation in the normal method, and later we will realize that we have not adjusted for the grant. These are certain very small mistakes that we tend to do in the exam. Okay, waste of time, waste of your presentation. You will strike out and write it again. You will yourselves be showing a haphazard or a wrong, clumsy presentation. So all this let's avoid. Read the question end to end clearly before you start the next step. So now I'm striking this off. Now let's do the working for depreciation. Cost 30 lakhs. Depreciation, before we go for depreciation, we are going to adjust for grant. Very good. Grant. What is the grant received? 12 lakhs. So the net cost of the asset is going to be 30 minus 12, 18 lakhs. Now go ahead and calculate. Depreciation is going to be 18 lakhs minus residual value of 6 lakhs divided by useful life of 4 years. So 18 minus 6 is 12. 12 divided by 4. Depreciation for year 1 would be 3 lakhs. Now let us go ahead and calculate the book value. So for year 1, the cost would have been 30 lakhs. Grant is also subtracted from the asset. So minus 12 lakhs. Minus depreciation for year 1, 3 lakhs. So now what is the book value? 15 lakhs. So this will be the book value of grant as on the start of year 2, which is in the year of refund. Right? Now, refund of grant. So what is the amount of refund of grant? 7.5 lakhs. So add 7.5 lakhs. 15 lakhs plus 7.5 lakhs gives you 22.5 lakhs. 22.5 lakhs. Now this 22.5 lakhs becomes your revised book value. 22.5 lakhs becomes the revised book value. So what will be the revised depreciation? Okay, the revised depreciation is going to be, I'm writing it here, 22.5 minus residual value still remains the same, minus 6 divided by, now I have already lost 1 year of useful life, I am left with 3 years. So divided by 3, which gives you 5.5. 5.5 lakhs. Remember, even when you calculate the revised depreciation, you need to adjust for the residual book value. Okay, this is not changed. Residual value has not changed in the book or in the question in this case. In the exam, if this question is come, they have only asked you the journal entry. So you will do all this in your working note calculation. Leave space for your journal entry, do the working note, and then come back and write your answers. Or even better, what I can say is the journal entry is not going to change. Write the journal entries. Leave the amount column blank. Do your working note, come and fill the amount column. That way you will save a lot of time, because journal entry comes from your mind directly when you see the question. We know what are the set of entries that we need to pass. Okay? So let's go ahead and check the journal entries. Only the entries for year 2. I am not going to give the other entries for previous year. So year 2, what are all the entries that we need to pass? Let us first recollect in our mind. Refund. After refund, what happens? Depreciation is changed. And for every depreciation entry, we have transfer entry. P&L transfer entry. So 3 entries. The first entry is going to be fixed asset account debit to bank account. 7.5 refund of grant. Narration mandatory, like I told you in the previous class also, being government grant on asset partly refunded. Next, depreciation account debit to fixed assets 5.5. Depreciation account debit to fixed assets 5.5. And the transfer entry for depreciation. Whenever you have an expense entry, transfer entry is mandatory. Transfer entry for fixed assets, for depreciation. Profit and loss account debit to depreciation 5.5. Okay. So 2 hints that we remember from this question. 1, adjust the grant if we are doing under method 1 before you calculate depreciation. Second, when you are calculating revised depreciation, remember at the time of refund, I need to also consider residual value and the remaining useful life, not the total useful life. So these are the points that you need to remember. You can take down the entries for your reference. The depreciation working note also I have given for your reference. Okay. So is the entries clear? Can we move on to question 2? Question 2. How would you treat the following in accounts in accordance with AS12 government grants? So this is a question where you have to write the provision and the explanation. First, rupees 35 lakhs received from the local authority for providing medical facilities to the employees. So what is this grant in the nature of? Is it a revenue grant or a capital grant? Revenue grant. So if it is a revenue grant, we need to take it to the P&L account. Very good. So let's write the explanation. 35 lakhs rupees received from the local authority for providing medical facilities is a grant received in the nature of revenue grant. Such grants are presented in the credit side of the profit and loss account under a separate heading called as other income. Okay. Or there is another option. You already have employee expenses. You can show total employee expenses less grant received for employee expenses. So alternatively, it can be deducted by showing it as a subtraction from the expense, which is employee benefit expenses. And yes, someone was asking online whether you can show the working note before. No, working note has to be shown after the journal entries. So write the entries and then come to the working note. In any question, working note has to be coming only after the main answer. This is a standard. So you will start with as per AS12. Grants received in the nature of revenue will be taken to profit and loss account. So that one line will give you the provision very clearly. So let's write it. Grants received in the nature of revenue shall be taken to P&L account. Next, 100 lakhs received as a subsidy from the central government for setting up a unit notified in the backward area. So what is this type of a grant? Capital grant. This is a capital grant because this is in the nature of a capital investment or a capital contribution. So as per AS12, where the government grants are in the nature of promoter's contribution, that is, they are given with reference to the total investment in the undertaking by contribution towards capital outlay, and no repayment is ordinarily expected thereof. Such grants are treated as capital reserve, which can neither be distributed as dividend nor considered as deferred income. Capital reserve cannot be utilized for any other purposes. In the given case, subsidy received from the central government for setting up a unit in the notified backward area is neither specific asset nor revenue. Therefore, it should be taken to capital reserve. Or you can write, in the given case, since the amount given is in the nature of promoter's contribution, it shall be taken to capital reserve. Simple answer, let's keep it that way. Can take down the hints. Moving on to the next. 15 lakhs received from central government on installation of effluent treatment plant. So here I have received it for an asset. So it partakes the character of a grant for specified asset. So It is because I am using a specific asset, and for that the government has given me the grant. So generally when the asset nature is recognized directly, then it becomes a grant for a specified asset. Okay. So in this case, what we will write? When the grant is received towards a specified asset, we have two methods. Method 1, it can be adjusted with the cost of the asset. Method 2, it can be taken to deferred grant. We need to say that both the options are available for the entity. So let's see the answer. 15 lakhs received for installation of effluent treatment plant is a grant related to specific asset. Two methods of presentation in financial statements of grants related to specific assets are acceptable. Under the first method, grant is shown as a deduction from the gross value of the asset and in arriving at its book value. So grant is recognized under profit and loss statement over the useful life of the asset by way of reduced depreciation. This statement is optional, friends. Even if you write the first statement, that gives you your main answer. So this first statement is what is the key. Under the second method, again the next one, grants related to depreciable assets are treated as deferred income which is recognized in profit and loss on a systematic basis over the useful life of the asset. So it is taken as deferred income. This is your keyword. Therefore, the entity has two options. Entity may either deduct the grant from the cost of the plant or treat it as deferred income to be recognized over the useful life. Always start with the standard name and number. You need not write which para, which section, nothing like that. At least ensure to quote as per AS 12, accounting for government grants. Then continue your answer. Please take down the hints. This is clear? Yeah. Next. Question number 3. Darshan Limited purchased a machinery on 1st April 2016 for 130 lakhs, useful life 4 years. Government grant received for 40 lakhs of the purchase of machinery. Salvage value at the end of the useful life 60 lakhs. Darshan Limited decides to treat the grant as deferred income. You are required to calculate the amount of depreciation and the grant to be recognized in profit and loss account for 4 years they are asking you. 17, 18, 19, 20. Okay, you're going to do the calculation part. Darshan Limited follows straight line method of depreciation. Okay, so for the 4 years, what will be the depreciation? This is a deferred grant method. So will the grant be adjusted with the cost of the asset? No, the grant will not be adjusted with the cost of the asset. So let's go ahead and calculate. Cost of the asset 130 lakhs. Residual value 60 lakhs. So which gives us the remaining balance as 70, right? Yeah. 70 lakhs, which has to be depreciated for 4 years. So depreciation is equal to 70 by 4, which is 17.5 lakhs per year. 17.5 lakhs per year. Now we cannot stop our answer here. We should also give the deferred grant value. Now the grant received is for 40 lakhs. So grant received 40 lakhs. Period is going to be for 4 years. So grant to be recognized as revenue or to be taken to P&L. 40 by 4, which is 10 lakhs per year. So depreciation will be 17.5 lakhs per year and grant taken to revenue will be 10 lakhs per year. Now if you have taken this down, if you have understood this, let us see how we write it in the examination. As per AS 12 accounting for government grants, grants related to depreciable assets, if treated as deferred income, are recognized in profit and loss account on a systematic basis or rational basis over the useful life of the asset. Okay, so it is not over a fixed period. The word is useful life of the asset. Remember that. Amount of depreciation to be recognized. Depreciation is 130 minus 60. So 70 divided by 4, 17.5. 17.5 lakhs depreciation will be recognized for the year ended 17, 18, 19 and 20. SLM, so no change in the depreciation. Amount of grant recognized in profit and loss account each year is going to be 40 divided by 4, which is 10 lakhs for the 4 years. Right? So whenever you write any question in a standard related, even if it is a practical question like calculation, start with what is the law. Start with as per AS, what is the rule or what is the information that you are going to capture. Is this clear, friends? So this summarizes our discussion on AS 12. Any doubts with respect to AS 12? Quickly run through and then next we will start with the next standard. Shall we continue? We are going to the next standard. Again, more practical related standard, AS 16, borrowing costs. Okay. AS 16, borrowing costs. What are borrowing costs? Borrowing cost is cost of borrowing or cost of financing. So they are costs which are incurred in connection with borrowings of the enterprise. When I say borrowing, it can be loans, it can be debentures, it can be any other form of borrowings. But it is not about capital. It is not related to capital costs. It is only and exclusively related to borrowings. It includes interest, finance costs, initial commitments on borrowings like initial commission, initial brokerage to be paid for borrowings, premium or discount on debentures. Okay. Any foreign currency fluctuation, like if I have taken a foreign currency loan and if I have a fluctuation because of the amount that is payable, that will also come under borrowings. Right? So borrowing costs relates to any amount that you are going to be incurring with in relation to or with respect to the borrowed funds. Okay. Now the standards rule is very simple. Yes, ma'am. When you are having a premium on redemption of debentures, it becomes a cost. Premium on redemption will be recognized either at the end or it can be amortized over the period. Okay. So now coming to borrowing cost, what the standard says. The rule of the standard is very simple. All costs will go to P&L account except for the cost relating to qualifying asset. So only two categorization. If it is qualifying asset, you need to capitalize the borrowing cost. If it is not a qualifying asset, we will have to take it to P&L account or charge it to P&L account. So this leads us to the next question. What is a qualifying asset? A qualifying asset is any asset which takes a significant time or substantial period to be ready for intended use, not to be used, to be ready for intended use. Okay, so any plug and play assets generally will not qualify for qualifying assets. Like machinery, if I can just bring it and start working with it, then it is not a qualifying asset. It has to take a substantial or a significant amount of time to be ready for the purpose. Generally, construction based assets, assets which are built or constructed or developed, will be taken as qualifying asset. An asset is normally ready for its intended use or sale when its physical construction or production is complete, even though routine administrative work may be continuing. Say for example, the machine is ready. I have constructed it. I can start using it. But some labeling work, branding work is all remaining. That does not amount to construction period. Okay, construction period will get completed the moment when your construction is complete in its significant form or when the process is complete in its significant form. So the standard says three things. In a qualifying asset, the moment it becomes a qualifying asset, you can start recognizing. What we can recognize? The borrowing cost can be recognized as a capital expenditure. Okay, so I can transfer the borrowing cost to a capital expenditure the moment the asset becomes a qualifying asset. So when capitalization begins, point number one. When borrowing costs have been incurred and activities relating to the qualifying asset have been initiated. I have a plan for construction. I have bought loan and kept. But if I am not doing the construction activity at all, if I am not even starting the activity, then I cannot capitalize this cost of construction, cost of loan towards construction. I should have started the work in relation to the qualifying asset. Second point given by the standard. When capitalization ends, when it is going to stop. So when it will stop, capitalization of borrowing cost will stop when qualifying asset is complete. Now when you say it is complete, when significant activities in relation to making the asset ready for use is complete. Okay, so basically the asset should be ready for use where significant work is completed and it should be capable of being used. Third point, what if there is a break in between? So I have started the capitalization. In between some reason I need to pause the work. I could not do the construction business. So I have, let us say I have a 2 months gap. Can I capitalize that borrowing cost in that for the 2 months, or for the 2 months should I take it to P&L account? The standard says if the capitalization has been stopped, if the construction or the construction of that asset has been stopped for a temporary period, which is prolonged in nature, where you do not know that when you will start back. In other words, when I stopped it, I didn't know when I'm going to resume or how I'm going to resume. So if it is for a prolonged period, then it is abnormal disruption. So for that period, you cannot capitalize the borrowing cost. I need to charge it to profit and loss account for that intermittent period. Again, when your work has started, then again start capitalizing. For that in-between period alone, we need to take it to profit and loss account. However, temporary delays relating in the process shall not be considered as disruption. Rains. We know that this period has to be given, so we cannot do construction in that period or we cannot do our work in that period. Okay, so if the temporary delay is going to be for a shorter period and you know that the work can resume, or if the delay is necessary as a part of the process. For example, for certain plant construction or factory construction, you need to give curing time. 1 month after the foundation is laid, I have to give time for the things to get set, and then only I can start the next work. So that time is required for the construction. So if it is either delayed due to for a temporary disruption, or if that break is due to the process itself, if the process itself requires that break, then it is not treated as a disruption or a abnormal delay. So in that case, for that period, you can still continue the capitalization. Right? So only 3 points. When capitalization will start? When the assets activities have started. When capitalization will end? When the asset is ready for its use, significantly completed. When capitalization is in between stopped and restarted again, so when it is disrupted, when there is a prolonged delay or a abnormal delay. So this is regarding the timing. Now coming to the last or the most important part, what will be the amount of capitalization? There are two types of borrowings, or there are two types of cost of borrowings, I can say. One, I have taken borrowings exclusively for this particular asset, specific borrowings. I wanted to build this factory. I have taken as a loan towards construction of factory, specific asset. I have taken debentures or public general loan for my business. But I have not, at the time of borrowing of that loan or debenture, I have not decided that this is going to be used for this purpose. I can use it for any other purpose also. So that is called as general borrowing. So borrowings can be two types. If it is specific borrowing, the amount that you have spent on borrowing cost, whatever is the cost that you are paying on borrowings, interest, finance cost, whatever it is, entirely eligible for capitalization. Okay. However, suppose I have taken the loan, 3 months later only I am going to start. So 3 months in between, because I did not want to keep it as idle funds, I put it in deposit, or I put it in some investments, and I have earned some income out of that. which means that income has an effect of reducing your cost. So the standard says, if you have earned any income from the use of the borrowed funds, subtract that income from the borrowing cost, and the net cost alone shall be recognized in capitalized in the books. So specific borrowing, entire amount of cost of borrowing can be taken for capitalization after subtracting any income. What is general borrowing? I have not specifically borrowed to that asset. I have borrowed say 100 lakhs, of which I am using only 40 lakhs towards this asset. So borrowing cost in relation to this 40 lakhs. Say suppose your borrowing cost comes up to 12 lakhs. So 12 lakhs into 40 by 100, proportionate cost shall be taken to capitalization. The balance cost will go to P&L account as expenses. Again, if you have earned any income from idle funds, it has to be subtracted. So general borrowings are not specifically related to the asset. The amount used towards the asset shall be the proportion for which borrowing cost is recognized after subtracting any income from temporary investments. And if I have multiple general borrowings, I have one debenture at 10%, I have loan at 12%, if I have multiple items, take the weighted average cost. Okay, so how to calculate weighted average? Total borrowing cost divided by total borrowings. So let's write that formula also. Weighted average rate is equal to borrowing cost for the year divided by total borrowings. Divided by total borrowings. It is always borrowing cost for the year. Why I am stressing on this? Let me again tell you. Sometimes one loan will be taken in the beginning of the year, one loan will be taken in the middle of the year. நம்ம என்ன பண்ணுவோம் ஃபர்ஸ்ட் லோனுக்கு 12 months கரெக்டாக கால்குலேஷன் பண்ணிடுவோம். செகண்ட் லோனுக்கு தெளிவாக ஞாபகம் வச்சுப்போம் 6 months. So we will calculate 6 months. Weighted average cannot be calculated like that. Weighted average is a percentage. So you should always take borrowing cost for the total year, irrespective of when the loan is taken. This is only for the calculation of rate I am saying, not for the value. Okay, for calculation of weighted average rate, remember it is always borrowing cost taken for the total year. For actual P&L amount and journal entry level calculation, we will do the normal method, 12 months, 6 months, whatever is the actual period. For percentage alone, remember this rule. And in case of specific borrowings are specifically taken for the purpose of asset construction. Hence, the amount of borrowing cost shall be fully eligible for capitalization after subtracting any income from temporary investments. Okay, so as per AS 16, very few points to remember for us. What is borrowings? What are all included in borrowings? What is a qualifying asset? When capitalization of borrowing cost can start, when it has to stop, what is temporary disruption, and what is the amount to be capitalized in case of general borrowings and in case of specific borrowings. Take a minute, run through. If there are any doubts, you can let me know.